carbon credits, which are the permissions to emit carbon and other greenhouse gases granted by governments, have been one of the best performing assets, commodities, in the last 2 years. A lot of investors believe that prices can go even higher. Joining me today is Jan Ahrens from SparkChange to discuss the recently launched SparkChange Physical Carbon EUA ETC, the world's first physically backed carbon exchange traded commodity. Jan, welcome. It's great to have you. Let's start off first. Give us an explanation of what are these carbon credits and how does the European carbon trading scheme work?
Thank you for having me. So let's go straight into this. It's first important to look at what kind of carbon credits are out there. And there are two different ways of thinking about carbon markets. First, there's a voluntary carbon market. This is what people naturally gravitate towards when they think about carbon credits. This is planting trees, essentially creating offsets. This is not what we want to talk about today. Today, we speak about mandatory carbon markets. And those markets are set up by governments like the EU to achieve specific emission reduction targets, like the EU 2030 climate target. And what they do is they issue a certain amount, a fixed amount of carbon allowances, pollution permits, that every polluter needs to buy to be able to pollute in a given year. These permits are handed out every year, and there are slightly less allowances available every single year so that emissions go down over time. And each polluter needs to buy these allowances on the market. And the economic idea is that the marginal cost to reduce emissions are setting the price for these allowances. So that's the EU emission trading system in a nutshell. It operates since 2008 and is by now the world's largest carbon market.
Okay, and so with SparkChange Physical Carbon ETF that you recently launched, investors can gain direct access or direct exposure to these allowances, right? So what benefits would this bring an investor? Why would an investor invest in these allowances?
So there are a couple of different ranges why you should consider such an asset class. On the one side, it's indeed, as you said before, a well-performing asset. And if you believe that Europe continues the fight against climate change, it's likely that there will be less and less permits available in the future, which means more scarcity and price is likely to increase. So there's a perfectly fine financial rationale. In addition, these assets, even though volatile, are uncorrelated. So there's a risk diversification aspect to holding these assets as part of your portfolio as well. But there are two additional aspects to it. Every company in Europe that is an energy-intensive company covered by the emission trading system is exposed to the price of carbon. And it's a cost for them. So the higher the price of carbon goes, some businesses will really struggle, which means it's actually a risk to your portfolio. If you hold energy-intensive European companies, you have an exposure to carbon prices. So holding it also hedges your financial risk against rising carbon prices in your portfolio. But most exciting probably is the impact aspect of holding a carbon allowance, because if you buy and hold a carbon allowance, this allowance is no longer available to the market, which means there is one polluter missing out on a permit to pollute and therefore needs to reduce emissions, which means you are directly impacting emissions in Europe by investing in this asset.
Okay, so we have an environmental impact, which I think is great. But would you say, because of the fact that these companies need these allowances to be able to continue their business sometimes, is it a market full of forced buyers? And how does this affect the price?
So indeed, you have compliance entities, around 13,000 entities across Europe that all need to buy these emission permits if they don't reduce emissions. So the majority of them get some allowances free of charge, and the remaining gap they need to buy in auctions. The government sells these allowances, so there is a constant flow of new allowances entering the market, but this flow is reducing every single year. So you're right, there is a market of forced buyers that need to buy it, but they have an alternative. They can reduce emissions. They can switch from burning coal to burning gas. They can implement energy efficiency measures or build generally more energy efficient or low carbon installations to reduce their emissions output and therefore saving costs. That's the ultimate idea of the system, so that the price is an incentive for those companies to invest in emission reduction technology, which ultimately makes financial sense for those companies.
Okay, and in the past, when we've seen investors, they've used funds to track the price or the price of futures contracts on these credits. The ETC that you recently launched buys and holds them, actually buys and holds these allowances. What are these benefits? What are the benefits that holding these allowances bring compared to tracking them?
You're absolutely right. That's the difference. That's the innovation we brought to market. So when you are holding a physical underlying, the physical allowance, we are actually, if you are investing in our exchange traded product, we are on your behalf holding these allowances in our registry account, our vault, which means they're actually removed from the market. If you hold a futures-based product that tracks the market, you don't have any impact on the actual supply and demand. There's no allowance really removed from the market. It only happens if you hold a physically backed product that you actually impact the market at scale. So that's on the environmental aspect. On the financial aspect, the problem is around the futures market trading in contango. So as you are holding futures, every year you need to roll to the next futures contract, and carbon markets usually trade around 70 basis points in contango. So there's a drag if you hold futures-based tracking products compared to holding the physical underlying. So compared to those futures-based products that are out there already, our product has a higher environmental impact and is cheaper on an annual basis.
Okay, and if we look a bit of the history of carbon credits and their prices, we saw that around the 2008 financial crisis, the price of these carbon credits fell dramatically. Have we seen the same impact with COVID-19 in this specific asset class?
That's a beautiful dive into the history, and let's go along that route because it shows how this market has evolved. The market is around since 2005, actually. It's now in its fourth trading period, and it had its teething issues, absolutely. So when the financial crisis came around, what happened in the market is emissions dropped drastically, but since supply was written into law and was issued every single year into the market, there was way too many allowances that were coming into the market. So prices were depressed. At the lowest time, it was trading at around €2.50. Which absolutely had made no incentive for industry to reduce emissions. So in 2018, the EU introduced a measure called Market Stability Reserve. And what this does now is it makes supply flexible, which means if emissions drop faster than planned because of a financial crisis or because of a pandemic, supply is adjusted at the same time. It's fully formulaic, it's written into law, there's no discretion around it. But it's operated since 2018, and this has kickstarted this bull run in carbon allowances because confidence is back in the market that the market will be tight for years. And that's what happened when COVID came around. So COVID reduced the emissions in Europe in 2020 by around 13%, at least within the EU ETS, where you would expect that prices dropped drastically. And in fact, prices dropped in early March when there was the entire sell-off on equity markets as well, but they recovered pretty fast because the Market Stability Reserve kicked into gear and removed allowances from the market to keep it tight. And in particular, this year, what we're seeing now is as emissions are going up again because of economic rebound and because of very high gas prices, prices have rallied significantly. So despite the fact that overall emissions went down significantly, the market remained tight and is now even rallying. So what you see is that what the EU learned from the early days from the emission trading system, the market evolved, there were multiple reforms into it, and by now it's a pretty resilient system that can cope with these economic shocks. So overall, COVID actually was bullish for this market because the targets of the EU to reduce emissions by 2030 got tighter. There would be less allowances in the market going forward. At the same time, economy is rebounding and emissions are kicking back up, which we don't want. So it becomes more expensive to pollute, hopefully incentivizing industry to reduce emissions going forward.
Okay, so just to finish off, as these allowances have now come back after COVID-19, we have more demand from companies. Do you expect the price to continue to trend higher in the short term because these allowances are going to indeed be capped after the supply has come back into the market?
Yeah, so it's interesting to look at this in the short and the long horizon. So in the short term, for the next few years, it's actually quite difficult for companies to reduce emissions at scale. It's not that easy to switch to a low carbon technology. If you build a more efficient blast furnace, or if you go to low carbon cement, it doesn't happen overnight. It's an investment decision that takes years to be built. You need to take the decision, you need to build the plant, and so on and so forth. So there's very limited short-term abatement opportunity out there. The only thing that can be done at the moment is to switch back from coal-fired power generation to gas-fired power generation. But even that, at the moment, at these record high carbon prices, it's not economical. You need prices well north of €100 at the moment to incentivize the switch from coal back to gas-fired generation. So there is not that much demand elasticity out there at the moment. You cannot really reduce emissions at scale at the moment in the short term. Say in 10 years time or so, hopefully industry reacts now, does its homework so that in a few years time we have abatement options out there. But at the moment it's difficult. And at the same time, what you have is this market stability reserve. It's still in operation. It still reduces auction supply, and it will reduce auction supply for the next few years. So the market remains tight for another few years, and therefore it's likely that we will see prices increasing over the next few years as well.
Great. Well, thank you so much, Jan, for all of your wonderful insight. That was Jan Ahrens from SparkChange talking about their recently launched Physical Carbon EUA ETC. To trade this and other ETFs and ETCs on IG, please head to the investment website.